That's how we build generational wealth. So in an IUL, in an index universal life policy, we have liquidity. We have access to the funds, and we have the ability to withdraw or borrow against those funds in a tax-free fashion that's going to allow us to move money in and out of the policy very dynamically, at will, no stipulations, no credit checks. Yeah, it's nobody's business but yours what you access the money for. Now we're here as an advisory team to kind of help you navigate and learn that process and really understand the ins and outs. But at the end of the day, it's totally at your discretion how you want to access those funds. So most advisors would recommend taking 5 to 10% and putting it away, 5 to 10% of your income, right, pre-tax, and putting it away into a vehicle where it's going to compound year over year, uninterrupted, and where you're, in this case, going to be able to access the funds at the same time while it's growing. Okay. And that's another thing, too, that I want to point out is that unlike TSP, right, unless you go back to work for the federal government with TSP, you're not contributing to TSP after you retire. In this case, you can. You can continue to contribute. There are no contribution limits, by the way. So if he has $500,000 of SGLI while he's still in, he adds $300,000 of that, and that death benefit is going to continue to grow with his cash value. So he's going to start out with $800,000 now of death benefit protection for his family, and it's only going to get bigger up until we start drawing income off of the policy. We stop funding the strategy after that, and he's accumulated $926,000 of tax-free cash value with a $1.1 million death benefit. He's now accumulated over $900,000, almost $1 million of tax-free cash value with a $1.1 million death benefit. You're never going to lose money in your principal. 9.5%. We can draw because we're confident that our policy is going to earn, our cash value is going to earn somewhere between 7 and 12, but we're never going to run out. We're never going to lose money. So we're never going to have to worry about running out of money. That's pretty cool. So they're able to start drawing about $80,000 a year tax-free. He didn't have to worry about taking $80,000 a year because he's doing it tax-free. He didn't have to worry about losing money to taxes and giving it to Uncle Sam. But in this case, we have a completely tax-free death benefit that's going to avoid probate. It's going to confer tax-free, and it's not going to affect their income levels at all. So even if this guy lives to be 85 years old, okay, after 18 years of income, his wife is going to receive $620,000 tax-free at the end of his life.